All right, good morning. Good morning. Today is Thursday, June 25th, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as our various social media pages. If you are with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team of Ann Colian, Josh Denny, and Karen Miller. Together, our goal is to help individual investors make their next financial decision and the one after that a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder and get a balanced analysis of what we see and ultimately to be a more informed investor. We do this in two ways. One, we can help you see your entire financial situation, both today as well as every year into the future through our personal wealth planning services. After today's message, if you'd like to learn more, you can go to clearfinancialfuture.com, and I encourage you to watch the very brief 2-minute video. And second, we help our clients get invested right. Being invested right is unique to each individual client that we serve. And SmartMix is our process for helping people do just that. So whether you have $25,000 or $25 million, SmartMix is our process for helping you get and stay invested right, unique to your personal situation. Again, after today's message, if you'd like to learn more about that, head on over to smartmixportfolios.com. Today, we're going to hear from our guest speaker, Tom Fox. Tom is managing partner and chief investment strategist with Water Street Research Partners. And as always, I am excited to have him here with us today. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. He is an incredible resource for all of us here at CCG, and we are excited to have him. He's got over 35 years experience building investment strategies. He has an impressive long resume, as you can see on the screen. And at the end of today's message, we will have Q&A with Tom. So if you're watching online, whether you're live with us or you are watching in the recording, please feel free to ask any questions in the chat box. You can also email me. You can also text our office number, and I'll be monitoring that during his message, and I'll bring those questions to Tom at the end. Today, we're going to hear from Tom. He's going to review the headwinds. He's going to review the positives in the markets and the economy, and then he's going to give us his outlook moving forward. And ultimately, again, this is your opportunity to kind of look over our shoulder, get a balanced, objective analysis of what is happening in the markets and the economy. So again, please don't hesitate. If you have any questions whatsoever, Tom is an incredible resource and would love to get you answers to any questions that you may have. So with that, I'm going to bring our theme for the year up on the screen. Bring Tom on stage. Good morning, Tom.
Good morning, Eric.
Thank you for being here with us today, as always.
Thank you.
So things have changed, and they keep changing.
They keep changing, and behind all the change is AI, this revolution that's going on. And we're going to talk a little bit about that. I'm going to give you kind of a big picture view in our presentation.
Excellent. Well, let's get those negatives out of the way, huh?
You like to get this done early?
Yeah.
So we always like to see what the worries are, or what the wall of worries are. And of course, we have a number of them. And then on the next slide, we'll be talking about why we should own stocks today. But there's always the markets. The old adage is climbs a wall of worry. And there's certainly plenty out there. And I think one of the biggest ones right now is the inflation risk. It's elevated. And even the new PCE came out higher than expected today. We got supply chain disruptions because of the war in Iran that's We're going to talk more about that. It's settling down. And we'll see what happens as we go down the road the rest of this year. But that's a big one, inflation, because as you know, the Fed has a dual mandate. They want to lower inflation, keep it around 2%, which we haven't been near recently. And of course, they look at employment. So they have that dual mandate of inflation and employment. And of course, what this does, it puts the Federal Reserve policy uncertain. We have a lot of smart people on both sides saying they're going to hold steady. Others are saying they're going to raise rates. A lot of evidence to raise rates right now with the inflation rate. And the employment numbers have been very good. So that has not been a concern for the Fed. So inflation is their number one target. And we'll talk about Kevin Warsh, the new head of the Fed, and see what he has to say and what his summary is in his first gathering. So another volatility, and usually the stock market historically during seasonal election cycle trends tends to go down during the summer months before the November elections. Now, typically it starts rallying again right before the elections and goes up the rest of the year. But we could have some seasonal downside pressure as we move along. And then, of course, we always have the geopolitical tensions. Is Iran going to hold? What's going to happen there? So that's always at the forefront, or not, something else happens. And then, of course, this has left global energy supplies tight. And there's really little, we've gone through a lot of reserves, so there's little room for more interruption. So this is a risk. And of course, all this eventually with the higher inflation impacts the consumer spending patterns, and that could weaken. Higher interest rates and higher inflation, growing debt burdens on households. Now, this is mostly in the lower income category of our citizens, but so far, we're going to look at a chart that shows the economy, the GDP, and the retail sales are still doing very well. But that's holding up for now. And then, of course, we have longer term rising government debt and deficits. And that keeps interest rates higher because they got to buy more or sell more treasuries to fund all the deficits. So that's a long-term negative, and we'll see how that all plays out. And then there's valuation. I mean, we're not inexpensive. We're kind of at this point on the higher end of valuation, and there's certain sectors like AI and tech that are elevated. They could go higher, but we're going to talk more about that. And then, of course, we are 4 years into this bull market. And so we're trending towards the end of historical bull markets. It could go a long time. And so it could be limited upside and some more downside risks as we continue in this bull market, which we're having another good year again this year. Well, that's the worries.
Let's look at some positives, huh?
We want to get to the positives. Okay. And we're tilted more towards the positives today. This is like inflation is the biggest risk on the other worry, but on the why we should own stocks, earnings are spectacular. We're seeing tremendous, unbelievable earnings growth, and expectations are growing. We're going to look at some charts on that. And a lot of it has to do is the AI-driven productivity gains. And this is only the beginning. This AI is going to filter through every sector of the market, every company, and we're going to see improvement. And there's all kinds of new things happening in AI. So productivity gains are amazing. We're going to look at a chart on return on equity, which is a sign of the corporate profitability, and that's going up higher and higher too. And of course, we've had the resilient economy. Employment's been good. Consumer spending's been good. Business investment remains very strong. So all this is good signs for the economy and thus the stock market. Then we have broadening market leadership. We started to see some movement away from tech recently into financials, industrials, and some of the infrastructure. sectors, and we're starting to see a broadening of the market going up. Now, there's a lot of room for this, but that typically is a good sign for the continuation of a bull market. And then, of course, we got the AI and infrastructure boom, massive spending on data centers, power, networking, semiconductors. We own a lot of companies in this area, and this we expect to continue. There's no sign of pulling back. We've got healthy corporate balance sheets. Many companies maintaining strong cash positions or in good position, becoming even more profitable. And of course, with the current administration, we're seeing a lot of capital inflow from other countries where U.S. is favored. It's one of the leading places to invest in. So we're seeing a lot of investment here in the United States, which is all good long-term for the stock market. And again, valuations are supported by the earnings. We're going to look at an interesting chart. Even though we're at new stock market highs recently, the valuations aren't going up. And we'll look at why that's happening. And then there's a lot of pessimism. We still have trillions, I think close to 7 trillion in cash, money market funds on the sideline, which means if more investors gain confidence, we could see a flood of money. There's a lot of dry gunpowder on the sidelines. And then we have history favoring staying invested. That's why we want to be in stocks. And typically, bull markets, Eric, tend to go longer than people expect.
Excellent. Thank you for that.
All right, this is big. Stocks will remain volatile. We had even today, the NASDAQ was up over like 2.4% this morning, and now it's down 0.18%. That's almost a 3% move in today's NASDAQ market.
Today, yeah.
Just today, we see lots of volatility. And if you remember, Eric, my forecast at the beginning of the year was extreme volatility both ways, up and down.
I think we can check that box.
That's exactly what we're experiencing. But through all the volatility, and this is why you got to put all your emotions on the side and take the long view, because we think bull is still intact. All right, why are we so bullish? Earnings growth accelerating. Now, this is an interesting chart. You can see the 2026 or 2025 in December, the estimates for the S&P 500 earnings were 351.74. Well, on June 18th, what is it? 399.25. That's $48 higher on the expected earnings. What drives stock prices, Eric? Earnings at the bottom line. And look where the earnings are going in this year's expectation. Now look at the PE ratio. Back in that earlier this year, we were at 19.4 on December 5th. Now look at the PE ratio. We're reaching new highs, and actually the PE ratio went down, dropped one point to 18.4. How can that be with stock prices rising so much? Earnings are driving. This has got real fundamentals behind the stock market rally.
Incredible.
Here's another one, return on equity. This is the profitability of companies per shareholder and the return on shares. And this is up to 22%. You can look historically from 1980. We're at record highs on return on equity on companies. Now, we've had weak sentiment. You can see the darker blue line has been going down since January of 24. More pessimistic. But what's the stock market been doing? Inverse, it's been going up. Now, when we dug into the details of a lot of these consumer sentiments, we found that it was based on your particular political party. The most negative are Democrats and the most positive are Republicans. They're on total opposite. Now, these are the averages, but it's interesting that you have two different views of what's going on in our economy and in the future of this economy. But you can see that there was a decoupling back in January 25 where sentiment kept going down, but the stock market kept going up. Now, here's another momentum stocks is the blue line. You can see what that's up 35% and 10% for the quality stocks. Now, quality stocks have really good balance sheets. They're not big time growth stocks typically, but they're just solid balance sheets versus momentum. And what a rising momentum segment of the market means is that it's risk on. So you can see we've had a risk on. Now that's a very volatile indicator. MSCI momentum can go either way fast. You can see the big drop there in this year, how it dropped, but it's back up, which means people are very positive about the stock market. Now we think they're going to be that the quality stocks will probably end up coming back up, and maybe some catch up to the momentum stocks, but we'll see how it unfolds. But so far, we're on a risk-on moment in the market. All right, this is, I really thought through this and been thinking a lot about this, Eric. So I want to give the big picture. And I believe, based on my research analysis, that AI is such a powerful foundation. And I want to say has the potential. Can we quote that potential? No guarantee.
Noted.
Potential for stock market gains, not just this year, but over the next several years. And I could see 2 to 3 years of AI impacting corporate earnings and revenues, and that this stock market may continue for more than a year or two. So this is the big picture, but let's look at the reasons for this. And well, number one is AI is driving major productivity revolution. Companies more profitable, they're significantly improve their efficiency and business function. This all goes to profitability of companies and stocks. And of course, the corporate profit margins are likely to expand. AI reduces labor costs, automate routines, improves decision-making throughout the organizations. This is why I've liked large caps, Eric, is because when you have a large company in the old days, it was very difficult to get a handle on all the components of your company, especially if they're geographically spread out. That has changed. Now, large companies today have the information to manage properly inventories and other things at such a dynamic way that it's almost like large companies can now act like small companies because of they're harnessing all the information needed to run the company. So I haven't been a big small cap fan, and I probably won't be for a while, because I think large companies kind of now have this recovery of edge on their information they have to run their company. That's my theory. I haven't heard anybody say that, but that's what I think. And here's another big one. AI acts as a deflationary force, lowering costs of delivering goods, services, increase in profitability. All these things add up that prices have the potential. And really, you have a tug of war, Eric, recently between oil prices and AI. Oil raises inflation. AI has the potential to lower inflation. And so if oil continues to head downward, and we went below $70, we were close to pre-war levels recently in the market, in the crude oil prices. We're at 71.66. We're down, way down from 112. And so if this continues and the Iran thing settles out, we could see now 2 lower inflation numbers impacts coming. One is from AI and lower oil prices. And the market's going to digest all this as we move forward. And another one is the AI infrastructure build out. Still, we're in the early stages, creating massive opportunities in data centers and generation. We have a lot of companies in this particular area. And then we have there's companies now developing new AI-driven products and services. This is going to add to the success of our country. Is these companies are a lot of young people. In fact, Silicon Valley, I heard they're working 7 days a week. These young people creating AI type of businesses. And we'll see where it all ends up. But somebody's going to come up with a revolutionary products and things in the future. So I'm very excited about that. And then we've got enterprise AI adoption remains in the early stages. The largest productivity and earnings gains are still ahead rather than already reflected in the results. And they're already impacting results. We're seeing it in a lot of financial measures. But I think this is going to continue. Right? I think we're in the early stages. And this is the big future is AI agent. Eric, you're going to have an AI agent in the future. I'll probably have one too, where it does a lot of our tasks and makes everything more efficient. And that's digital workers. This is going to change a lot of companies as they improve the AI agents. But that's where the future is. And everybody will have their personal assistant, so to speak. Mm-hmm. Then, of course, all this leads to stronger earnings growth. And ultimately, it could end up with higher stock prices. And I think the large cap technology leaders are positioned to benefit still. Highly volatile, but I still think they still have the upside. But in my last part of that sentence, all industries will eventually benefit. That's a growing thing that's going to happen. That's definitely in the early innings. So what does this mean? The potential to become a multi-trillion-dollar economic catalyst. This is comparable to when electricity was invented, when automobiles were invented, the internet was invented. And I think it's even bigger. It will fundamentally transform how everything is done, including work. And it's all going to benefit stock fundamentals. So that's why we're bullish for the next several years. We're going to have tons of volatility. We may even have a correction. There's a possibility of a bear market on the way. We still think bear markets probably not going to happen, but we still see 10% pullbacks. I would look at it this way: 2 steps forward, 1 step backward. That's what the stock market's going to be doing. And we're seeing it already.
You make a very good case there, Tom.
Thank you. And here's the AI spending. This is just Amazon, Google, Meta, and Microsoft and Oracle. And you can see, is this a J curve or what? This is a hockey stick. So this is where the spending's going. And then there's a lot of businesses that have to support all this, which is good for a lot of companies. So this is not slowing down. I was listening to a this company, and this company who builds digital centers saying they see no slowdown in the growth of digital centers. Or AI centers. So we're going to see that continue to grow. And there's not even one sign yet that this is going to level off. All right. So we think that there will be some leadership beyond the hyperscalers, which are the people that make all the chips and things like that to run AI. You can see the suppliers of what's needed to run AI, and then you can see the customers. You can see the big difference in performance. We think that that yellow line will slowly go up, and there's opportunity. I call them the adopters. How many companies really start to adopt AI? And I think that those lines will slowly come together. But I think right today we're still in the supplier bull market. But I think it's going to shift, and we're going to keep our eyes on that as we move forward.
Cool.
Here's another look at that. This is the equal weight. And by the way, this year, equal weight, it was slightly ahead of the cap weight. And of course, cap weight has the big technology companies, the AI companies, as the biggest contributor to performance of the cap weighted S&P 500. But you can see there's still a lot of room. But so far, it's been kind of a tug and war between the two, cap weight and equal weight right now. If the equal weight starts performing better, what that tells me is that there's broadening of this. Other companies are starting to be impacted by AI in their business.
Okay.
All right. Well, we got a new Fed chair, and we got interest rates and inflation. So Kevin Warsh is our new guy, and he's taking over for Powell. And he basically 5 takeaways from his current press. He went public. We call it a presser on the FOMC rate decision. They held steady, as you know. And what Warsh likes is the S&P, and that's the economic projection. It's a summary of what all the Fed members think of where things are going. Remember, a lot of our Fed decisions have been backwards looking. Under Powell, they would go by the data, historical data. Warsh is a forward-looking guy. Where is it going? Can we anticipate that? So that's why they're looking at the SEP, the summary of economic projections. That comes out once a quarter. And so he's moving in the Fed from backward-looking to forward-looking, which I think is very positive. Plus, he's creating 5 task forces to reform the agenda. Where do they get their data? A lot of the data the Fed's been looking at needs to be updated. It's not working as well on really telling us where things are. So that's going to be modernized. We think this is going to be really great for the Fed and their decision making going forward. And of course, he's not letting inflation go. He wants to get inflation to be credible, and they're still aiming for around 2%. But once he gets there, then he'll figure out a way to drive that to 2%. I think if oil comes down, AI keeps moving, I think he's going to get there. And Kevin Warsh really believes that AI is going to really impact inflation in a positive way. So he likes to communicate still, cares about speaking to the public investors, not going to disclose as much as Powell, so we're going to be surprised sometimes. And now some of the market, there's kind of a 2 sides. Some think they're hawkish, some think they're not hawkish. And so we're kind of on that Warsh is not hawkish, but he's dynamic. And we'll see how he works things through. But I think if oil remains low and AI keeps running, I think he's got to have a big tailwind down the road over the next year. All right. Well, the stock market was up, and then it kind of been jumping around here. Why? Well, they're trying to digest where the Fed is going, and there's lots of opinions on this. So we're digesting the new Kevin Warsh and his leadership, but we'll see what happens. But today, interesting thing on the next few charts, this is the market's view of where interest rates are going. This is market implied versus the Fed. You can see the market expects higher rates than the Fed actually is indicating, which is an interesting point of view. And I think all of it has to do with the Iran oil price increase, which is now seemingly going to maybe go away. But right now, today, the market expects higher rates relative to the Fed. Now, there's some reasons for that. So here you can remember that in March of 26, Eric, the market was expecting 2 cuts, 2 interest rate cuts. Now they're looking at 1.6 or almost 2 hikes. But they've reversed course. You can see the 0 line, which is no cuts or raises. But another way to look at it on the next chart is how does the 2-year relate to the Fed funds? And right now, the 2-year yield is pointing to a possible 0.6 increase in the Fed, which is another 2 hikes. So we have two different ways to look at it. And what this is saying is the market still is thinking that the Fed is more likely to raise rates than to hold them or even lower them. But I think the oil impact in the change of the pricing we've seen recently, if it holds, could end up where this goes back to being flat again. But we'll see. We're kind of I'm kind of believing that they'll probably hold for some time rather than raise rates like they're pointing to here. But we'll see. And if it does go the other way, if this sentiment from investors changes, that would be very positive for the stock market. All right, so you can see the PCE is way too high. We've got core PCE. The Fed target is the green line. We can see inflation was going sideways and now it's up. And this is all because of oil. So we'll see what the longer term impact if oil prices remain lower. But this is obviously pushes up against stocks in the long run. See that on the next chart.
This one?
Oh, okay. Well, this is no, not this one. We'll see this. But here's the look at the price is 74. It's actually 71. Eric, oil dropped below 70, 69 something. And you can see we are almost back to the war premium. However, because of the oil impact on prices of goods and other things, you can see rates have been rising. So there are two different things going on here. Now, obviously, oil is a leading indicator for rates, but we'll see. We think that the rates will eventually start coming down once the oil impact starts to be seen in some of the numbers. Now, here's true inflation, and some think that the CPI is an old measure and sort of needs to be modernized. But true inflation looks at millions of indicators, and they're showing a 1.84 inflation rate. You can see their historical; it's come down, so they have a different view of where overall. When you got CPI showing 4% inflation, they're showing 1.84. So who's right? I'm not sure, but it's a broader view, more modern view of the inflation rate. This is something now. This is a market worry. When yields go up, the PE ratio comes down. You can see where we are, way on the far right today. The PE ratio. Now that's historic. That's a trailing PE. But you can see that how it slopes up to the left, which tells you that if rates rise, so will PE ratios go down, which means that as rates rise, stocks tend to trade at lower valuations, which means stocks could fall. So this is something that you got to keep your mind on what happens, what's going to happen down the road here and where yields go. That's why it's important that yields hopefully hold and even go down if oil stays where it is or even lower. All right, I want to talk about IPOs and retail investors. Of course, we've had IPO, big IPO, and more are coming. Eric, there's several coming down the road. But I wanted to point out that it's 55% or 56% of IPOs, Eric, have had negative returns. So it's a lower number percentage that have actually had positive returns. And of course, we got these big named AI IPOs that have one's come out, another one more are coming. So we'll see what happens, and they can be very volatile, very volatile. And sometimes I tell people, maybe wait until you get your first earnings report, and then we'll see if the rubber meets the road. So that would be my advice. Wait for earnings. Now, here's a positive sign. You can see Many people are getting involved in the stock market. This is retail owning record percentage of stocks. This is, of course, bullish when the retail market's in there. And so, of course, this is part of driving up to new record highs, is that retail is really enjoying the stock market. All right, I said the economy, remember, remains solid, and you can see we have two number here. The headline GDP has been rising on the far right, and you can see retail final sales is rising again. This is all positive. We're not below the zero line, so this is all good. This is very positive that we're on solid footing so far for this economy, which is important. All right, well, let's see what we're forecasting. What does all this mean at the bottom? What's our bottom line? Extreme volatility. We've had that in there, Eric, since the beginning of the year. Both ways, up and down, especially in AI, memory chips, lots of volatility. Economy slows but stays resilient. That's exactly what we've been saying, and that's what's happening so far. We forecasted, I think last month or 2 months, I can't remember, that the war in Iran would come to an end and stocks will reach new highs, oil prices fall. That's happening right now. And now I put here, inflation starts this. I've been saying this. It's a long journey lower when you've had the high oil prices. It's like a ship coming in. You got to break miles out before you dock. So it's a lagging indicator on oil. So, but it will be a long journey. But if oil stays low, AI keeps going, I think we're going to be heading lower on inflation over the next 12 months. So we are bullish on stocks, still are. We have been all year. Pullbacks and weakness, we see it as a buying opportunity, especially when you get big downdrafts in some of the tech area. Policy supports there. Earnings are spectacular. And of course, AI productivity gains are increasing. So we think AI stocks will continue to lead. High quality technology AI beneficiaries will continue to dominate. We do think it's going to expand out to the other companies and industries eventually over the next 12 months. But for now, we still think will maintain the leadership. And of course, we've held here. I think we've been here the whole year. This is for the S&P 500. We may be higher than this, but the S&P 500, 10 to 15%. We're below that right now by year end, and it could exceed our forecast, especially if oil remains in a falling moment in price. So here are wild cards. This is geopolitical events. You can't forecast these. You can see 3 highlighted that were hit. We had this at the beginning of the year. Some of those we could take off and turn into gold from red, but those 3 have been causing a higher inflation. And there's all kinds of things that can go on. Of course, you can see one of them is the election instability. That we see more volatility as we get closer to that November date. But typically, the markets begin to rally right before the election and afterwards. So we'll see what happens. Of course, you have a lot of other things listed there. But that's my economic and market forecast.
Excellent, Tom. As always, we appreciate you. You're very balanced, objective analysis of everything, both the positives and the negatives, and help us all make sense of it. So really appreciate that as a resource that we use throughout the month. So often pointing back to this presentation. So again, thank you very much. With that, I'm going to open it up to any questions. So if anybody has any questions as you're watching this, feel free to send me an email. You're also invited to text our office number, which is 952-540-0153. We would love the opportunity to circle back with you if you have any questions now or in the recording. I will also this afternoon have a summary of Tom's message here as well. As soon as possible, we'll have it posted on the website. So if you'd like that, you can go download just a nice brief 2-page summary I've been working on right here. And this presentation is recorded, so it'll stay on the website for some time. Again, we like to refer back to this throughout the month. Pencil in for July. We have not firmed this up quite yet, but we are penciled in for July 23rd. That's a Thursday for our next monthly update. We do this every month, and love to hear from Tom on that regular recurring basis as things continue to change. And like I mentioned, we'll have the summary and the ability to ask a question right on the website there as well. So if you go to the website later on, you'll see this new button that says ask a question. So if you'd like to ask a question more anonymously or privately, I should say, you can do it right there. Every Monday morning, I start my week off with a brief summary of what's happening in the markets. So if you'd like to join me, 9 a.m. Central Time, 3 to 5 minutes long, maybe 6 or 7 sometimes, kind of going through what happened in the markets, some of the things that we're looking at for the week ahead. This is on Facebook, on YouTube, on LinkedIn, on our website. So whatever your favorite platform is, you're invited to join me on those Monday mornings. And then at 2 o'clock Central Time, I send out a more in-depth email with additional items in there. So if you're not getting that email, you can subscribe at our website, www.investwithccg.com. Tom, I don't see any questions right now, so I'm going to bring up a little bit of fun here. Like everybody, if you have not received it in the mail yet, save the date. We have our annual Capital Cruise Client Appreciation Dinner on Lake Minnetonka, reserved and scheduled for Thursday, August 27th. So save the date for that day. Couple 3 hours out on Lake Minnetonka. Always a fun time every year. So mark your calendars. So I don't see anything right now, Tom. So I will let you have another minute if you want to offer us any closing thoughts. Otherwise, I can wrap us up.
Yeah, I would just say this, that as we've said, I think in the last few presentations, to keep your seatbelt on, lots of volatility, and don't get too emotional on the portfolios. Good investors are non-emotional, but we do see many positives that we believe will continue this bull market. So we think there's still a lot of opportunity in front of us.
Very good. Well, as always, Tom, thank you so much. Hope you have a wonderful rest of your day, and hope everybody watching this live or in the recording, we hope you have a wonderful rest of your day as well. And that concludes this month's Capital Markets Update and Outlook for June 2026. Take care, everybody.